Talk about the top stories. Tether paid a $300 million settlement to Celcius's bankruptcy estate. Yesterday, the Blockchain Recovery Investment Consortium announced the deal to resolve claims made in August 2024. The allegations concerned Bitcoin transfers from Celcius to Tether, leading up to Celcius's 2022 bankruptcy. Tether CEO Paolo Ardoino said on X that Tether is pleased to have reached the settlement. Next, former UK Finance Minister George Osborne says the country hasn't been ambitious enough in crypto. Osborne, who's now a member of Coinbase's Global Advisory Council, joined Squawk Box Europe, where he expressed his disappointment in the UK's crypto progress since his departure from office. He points to recent momentum in the US as a comparison.
The United States has gone from being pretty skeptical to now very positive, and big legislation passed earlier this year in Congress, which has created a lot of opportunity for companies like Coinbase who, sit on their advisory board. So I think it's not just the UK, I think for other European countries, other jurisdictions around the world, that kind of moment when America was a laggard has gone, and now the rest of the world, including the UK, has got to play catch up.
He also added that he believes there will be growing use cases around stablecoins, and that governments can't predict private sector innovation in areas like stablecoins, as well as tokenization. And by creating a framework, then innovation may be enabled. All right, let's talk about markets again for our main story. Crypto World's Brandon Gomez spoke to John DiAugustino, head of strategy for Coinbase Institutional. They spoke about what's driving the crypto pullback, Bitcoin's status as a risk asset, and more.
So let's zoom out and have the macro conversation first, right? Major cryptocurrencies have melted down from highs this week. What do you make of that drawdown? I mean, is it a reaction to some of the macro headwinds, the government shutdown? What's leading it?
Sure. Always challenging to imply causation where correlation exists. But I think general consensus seems to be that this was ticked off, if you will, by the tariff threats against China. However, I think it's important to appreciate that when talking about these meltdowns or these volatility blips, we tend to use absolute numbers. So we hear numbers like, 6 billion was liquidated from crypto, 17 to 19 billion was liquidated from crypto markets overall. And those are scary numbers, I get that. The context of the market sizing is equally important. So if we think about last year to this year, Bitcoin's market cap has gone from about 1.2 trillion to 2.2 trillion. Crypto overall has gone from about 2.3 trillion to 4.3 trillion. So when you look at those scary numbers, and they are scary, no question, especially if you bought in recently, 6 billion of liquidations in Bitcoin and 19 in crypto overall represent 60 basis points and 44 basis points respectively. So it's a little scary. I get it. And I'd love to talk to you a bit about I think why it's scary. But I do think the context of the market sizing is important to consider.
Well, and I want to, sort of get into the drivers, right? Because I know that you've also talked about a decoupling of crypto markets from these, macro headwinds and tailwinds, allowing the asset to trade on its own merit, especially. So what do you think it is that is so scary to investors right now that maybe you can abate some of that fear? And what is driving prices? I mean, is it sort of the Washington headlines right now? And how long do we have until we are able to decouple, like, you've talked about in the past?
So I don't think anything ever is truly decoupled. We live in a somewhat homogenous financial world in the sense that while assets exhibit characteristics during normal course, when there's panic, that panic tends to affect everything. So I don't think any asset, I remember back in my old days in commodities, we used to talk about how commodities were generally decoupled from broader equity and debt markets. But I'll remind you that during a recent panic in the last 2 years, crude oil, the world's most valuable, stable commodity, was negative. Actually traded negative for a brief period of time. You have to pay someone to take the world's most valuable commodity off your hands. So I think the better question is, it's a very good question, but I think the question people should ask themselves is two things. One is, markets like crypto tend to resemble commodity markets in that you can have very, very deep liquidity, right? The thing can trade 1 billion times a day. It trades like water. But you may have a concentrated group of market makers or key market participants. And if they take their foot off the gas, and unlike equity markets, crypto and commodity market makers do not have an obligation to continually post prices. So that liquidity can ebb and flow as the fear sort of ebbs and flows. But I think the broader point, Brandon, is, and this is what I've been kind of thinking through recently, so bear with me. If you think about like when market meltdowns happen in equities, and I sit on the boards of some entities that invest in private equity and venture capital, and a really interesting thing happens. So public equity markets COVID happens, they wipe out, it's complete bedlam. Private equity and venture capital don't move that much. It's kind of odd. Like they kind of just don't move nearly as much as equities. And that's because their cadence is much slower. They tend to market quarterly. They have more time to absorb information. Crypto is to public equity markets what public equity markets are to venture capital and private equity, in that it's so much faster. It's so much more transparent. It operates 24/7, near instantaneous settlement. So what I would offer to you, and I'm not sure if this makes people feel better, is what they're seeing in crypto is the reality. They're not seeing a watered down version that shuts down at 5 o'clock every day or prices quarterly. And so if you're going to invest in sort of idiosyncratic assets like meme coins and other things that are prone to illiquidity, you run that risk. But I would rather know what my mark to market is at any one point in time than have that sort of hidden by a slow cadence.
And I think the point that you're making is one that institutions are starting to understand, that level of transparency, because we've been talking a lot about tokenization as well. It feels like that could be a contender for the word of the year. But I'm curious.
Stable coins and tokenization. Yeah.
Yes.
I'm sorry to interrupt.
Truly. Yeah. No, please. Absolutely. And I'm curious, what the appetite you're hearing is from U.S. companies. Do they have this understanding that you're sort of articulating now?
So they do. And so there's two stories happening simultaneously, and they couldn't be further apart in tokenization. So the one is this sort of slow grinding move forward that institutions are realizing, hey, this is a better system for transferring and recording value. And you see it because Larry Fink gets up and says everything's going to be tokenized. Every major exchange in the world, stock, commodity, whatnot, are looking into building tokenized trading systems because it's just better. And now I don't know about timing. I started my career on the floor of the NYMEX when it was open outcry, New York Mercantile Exchange. And that wasn't 1962. That was 2004. And it takes a long, long time for these legacy systems to change because A, they work really well. And B, they're important. So I understand why it takes time. But if you talk to anybody who's thinking, who has more than a 10-year career at these institutions, they know that this is coming. On the flip side, you have the retail exposure to tokenization, which has largely come through this form of meme coin, which I think generously the most generous view of meme coins is they're somewhat frivolous. There are people who disagree with that, but I think the mainstream view is that. Now, here's the irony of all this. The reason the institutions are so confident that this value transfer mechanism is the future is because of these meme coins. Because despite being maybe perhaps frivolous, they have proven their resiliency. When you read about a meme coin going up and down $1 billion at 2 a.m. on a Friday night, that means billions of dollars of value has been transferred peer-to-peer across an infrastructure that is proving 99.99999% uptime, which is what you need to operate an exchange. So that's the ultimate irony, is the stuff that people are reading about and maybe making fun of is actually proving out the resiliency of this infrastructure so that institutions can feel comfortable using it.
Okay, that's all for crypto.